right? What we do is we look at two rates. We look at the coupon rate. Sonny, can you bring that up? Coupon rate?
You're up.
All right. And the market rate, which is also known as the yield rate. All right. Now, the coupon rate is also called your stated rate. All right. The stated rate is the actual interest amount that you will receive, all right, if you buy bonds. You're the investor. But we're going to be covering this today, the corporations that issue the bonds, which means they have a bonds payable and a bond discount or premium. All right. So the stated rate, let's assume it's 6%. All right. Now, in order to determine how much his interest is paid, you take the stated rate times the what? Anybody? What do you do? Come on, tell me. At the exam, you're going to have to answer. What do you multiply by?
The face value.
Face value of the bonds. Very good. All right. Stated rate times face value of the bonds. All right. We'll give you the interest for a year, right? All right. But if they pay interest semi-annually, your semi-annual interest payment will be 3%. All right. And you have to look at the number of periods. We'll talk about that in a second. But actually, you're paying 3% every 6 months. All right. If you multiply that by the face amount of bonds, it'll tell you how much you pay every 6 months. Now, the market rate, also known as the yield rate, is the rate that similar bonds are paying on the market. So, all right, you pay 6% a year, but similar bonds pay 7%. Now, are you paying a better rate than the market rate? Yes or no?
Yes.
No.
What are you paying to your bondholders? What rate?
6%.
All right. Now, other bonds are paying 7% on the market. All right. All right. So, are you paying as good a rate as other bonds are paying?
No.
No. So, if you're not paying as good a rate as the market, then you're going to have to issue the bonds at a what? Discount or premium?
Discount?
Premium.
Premium. All right. Why would you be entitled to a premium if we're only paying 6%, all right, and every other bond which is similar is paying 7%, all right? We're going to have to issue it at a discount. Do you understand that? Yes or no? And by issuing it at a discount, all right, when you take the discount plus the interest payments, all right, it makes your rate equal to the yield rate or the market rate. That's why you issue it at a discount. All right. Has everyone got that? Yes or no?
Yes.
Yes. All right. Now, let's go to page 2H15. Sonny, 2H15. All right. Now, let's talk about valuations of bonds. And by the way, we'll be doing questions also. All right. Now, it says here, bonds are valued at the following. To determine the issue price of bonds, you're going to take the present value of the principal of bonds, all right? And also, you're going to take the present value of the interest payments of the bonds. Those two amounts added together should give you the issue price. Now, here's an example, all right? We have $100,000 5-year bonds issued January 1st, 2020 with a face or stated interest rate, okay? All right? Stated rate, coupon rate, that's the rate you're actually paying on the bonds. All right. Now, semi-annual payments of interest are paid on June 30th and December 31st. All right. Now, notice what it says here. All right. Under the calculation of 5,000, it says for bonds with semi-annual interest payments, in order to determine the value of the bond, you have to multiply the number of periods by 2. Do you see that? All right. And divide by the market rate by 2 in order to choose the present value table. All right. Now, let's look at an example of how we would calculate the valuation of a bond, all right, which is equal at par or face value. All right. First of all, when are we selling the bonds? Today or in 10 years?
10 years?
We're selling the bonds in 10 years?
Oh, no,
Why
no,
do
we
we-
selling today. Today, I'm sorry.
Today, we need the money today, don't we? Right?
Yeah.
If we wait 10 years, what's going to happen? All right. We'll be on the bread line. All right. With other bankrupt corporations. All right. So remember, you're selling two things today. You're selling the face amount of the bonds today, and you're also selling the interest payments that you're going to pay throughout the bond. And you want to figure out what those interest payments are worth today. All right. So when you think about what something is worth today, you think of what table, right? Present value table or just a compounding table. For example, all right, if I want to determine how much the face amount of the bonds are worth today, all right, which present value table am I going to use? The present value of $1 or the present value of an ordinary or annuity due? Which one?
The $1.
Ordinary.
The $1. All right. Remember, the present value $1, all right, gives you the present value of that future amount, the 100,000, and what it is worth today. Okay. Now, when you go to the present value table to get the present value of that 100,000, okay, that's the bond. All right. What do? You go to the present value of $1 table, right?
Mhm.
Now, when you go to those present value tables, there's two things you have to know. What interest rate am I going to use to discount the bonds? And also, how many periods will I actually discount the bonds? Now, let's assume we have this scenario, okay? All right. It shows us here that the present value of the principal at the maturity is 100,000. And also, the present value of the semi-annual interest is 5,000. Now, where do they get the 5,000? All right. First of all, they show you. If you move up, just leave it there, Sonny. Don't move up. But if you take the 100,000 times what? The stated rate or coupon rate, that will give you the annual cash payments for interest. But, all right, if you're paying them semi-annually, all right, you're going to pay it on June 30th and December 31st, right? All right. So what are we going to do? When we go to the present value table to get the present value of the 100,000, we use the present value of $1. Now, what rate will we use?
The yield rate.
The
Mark-
yield or market rate, right?
Yes.
And if they pay, all right, interest semi-annually, you'll take the yield rate or market rate and take half of that. All right. You understand that?
Yes.
So every 6 months, you're going to give a yield. All right. Now, also, all right, so you take the present value of using the market rate of the interest payments. Do you understand that? And
Mhm.
also, all right, forget what I just said. We're going to, the 100,000, we'll take the present value of $1, all right, for the number of periods. So if it's a 5-year bond here, how many periods are we discounting that 100,000 for? 10 periods. 5 years, semi-annual is 10 periods, right? Now, if the yield rate is 10%, all right, what's the yield rate here? Do they tell us?
Yes.
All right. If they do, I don't see it. All right. Now, 10% is a what? The face or stated rate, right? All right.
Oh, they don't say it.
All right. Okay.
Yeah,
All right.
check.
By the way, if there's any children there, we must dispose of those children. Okay. All right. So let's go over this. We'll go to the present value of $1 for the 100,000, and we'll take the yield rate. And if it's semi-annually, we'll take half the yield rate for our rate. And all right, we'll take the number of periods we're paying interest. So if we have 5 years, we pay interest, and it's paid semi-annually. How many periods are you going to look at to get the factor of $1, the present value of $1? All right, we have 5-year bonds. The interest is paid semi-annually. All right, how many periods are we discounting?
10.
10. All right, so let's go over this. First of all, you want to get the present value of the $100,000. All right, because I'm selling today the promise to pay the present value of $100,000. All right, using, all right, the what? Going to the factor of present value $1, you take what? You take the number of periods you're paying the interest. If they're 5-year semi-annually, you're going to look for 10 periods, right? And if the yield rate was 10%, all right, what rate would you use to get the factor for present value $1? Half of the 10%. Did I say that? Or 5%?
After that.
All right, now let's look at this example here. All right, it says here, the present value of the face amount is 100,000. Now let me get some facts here. There's a present value of $1 factor, 0.61391. All right, now what is that factor? All right, it's the factor for the present value of $1. All right, now what is the yield rate annually?
It's 10%, huh?
10%, right? Because we always use the yield rate, right? So if the yield rate is 10%, all right, and that's the annual rate, semi-annually, every period we're going to yield 5%. Do you see that?
Is the yield rate the same as the stated rate?
Yeah, let me ask you a question. If the yield rate and the stated rate are the same, we're going to issue those bonds at what?
At par.
The market.
At cost.
Par.
At cost.
The face value of the
Face
bonds.
value, yeah,
all right?
but I
Hey.
don't see the yield rate.
Well, the yield rate, I'm telling you what it is. It's mentioned. Where's the yield rate? All right, don't worry about it. It's got to be given to you. But I'm telling you, the yield rate is 10%. All right, and the coupon rate has to be 10%. Okay. Now, once again, we take the 100,000, we multiply the present value factor of $1. All right, we have here 10 periods. It's a 5-year bond. We pay interest semi-annually. So we're going to pay interest for what? 10 periods. And the yield rate is 10% a year. So therefore, for every period we pay interest, all right, this is going to yield us what? 5% annually. All right. Is that true?
Yes.
All right.
No.
No.
Semi-annually,
All right.
sorry.
It's going to yield us
Semi-annually.
10% annually. All right. Yield will be 5% semi-annually. Do you see that?
Yes.
So, all right, we get a total of 0.61391. I'll show you examples of this in a second. Now, what else are we promising to give you when we sell you bonds? All right. What do we promise? Is this problem the stated and yield rate the same? All right. How are we issuing these bonds? By the way, please shout out your answer. All right. Because if I have to read every one of these things, we'll never get done. Okay. All right.
These bonds are being issued with the stated rate and the yield rate being the same.
Right. The bonds are being issued at par or face value.
Yes.
That means that the yield rate and the coupon rate are the same.
Yes.
Okay. All right. Now, the next thing we have is we're promising to sell to the bondholder interest, right? All right. We're going to make interest payments to them. All right. All right. I forget how many periods it is. Is it 10 periods?
Yeah.
All right. And we take our stated rate. Now, what is our stated rate for 6 months?
5.
5%.
5%. So 5% of $100,000 gives you the interest payment, right?
Mhm.
All right. Now, we're going to take the present value of an annuity due or an ordinary annuity. If we
Annuity
pay
due.
interest semi-annually, are we paying interest, all the interest for the year on the first day we enter into the agreement? Yes or no?
No.
No. So to get the present value of that 5,000, we're going to use the present value of what? An annuity due table or an ordinary annuity?
Ordinary.
Ordinary annuity. Good. And that's 7.72173. Okay. Now, for how many periods are we going to take the present value of the interest payments for?
10.
10.
10, right? 10. All right. And what's the yield rate going to be annually?
5.
5%.
Annually 10.
Annually, it'll be 10%.
Yeah.
The yield rate and the coupon rate are the same, right? 10%, because we're issuing the bonds at face value. All right, you see that? We're paying the same rate that everyone else in the market is paying. So we're going to just sell it at the face amount of the bonds. All right, do you see that? All right, now let's look at, first of all, on page 2H16. 2H16, all right? Now, here's an example we're going to look at, all right? The example says, we're issuing bonds at par value. The contract rate, which is the what? Stated rate is 10%, all right? The market rate or the yield rate is 10%. So without even calculating the price of the bonds, I know the bonds are going to be sold at what?
Thank you for previewing the Yaeger CPA Review course materials. To learn more or to purchase the full course, visit YaegerCPAReview.com or click the link in the description.